Hi, I'm Bill Holliday with AIO Financial. I'm a certified financial planner, and I'm going to go over our investment strategy for our clients, how we build portfolios. Let me start here. There are three main pillars that we'll go over: the risk-based models, the different models we have, the different distribution of stocks versus bonds, the diversification, the global distribution of our portfolios, and our active rebalancing. So let's start with the different models we use. It's really driven on your time horizon when you need money and your risk tolerance. So we have 11 different portfolios or different models that we use, from very conservative, very little in equities, stocks, and we use exchange traded funds for the majority of our investing, to very aggressive with a lot in the stock market. We, if you have a long time horizon, you have more time to ride out the ups and downs, and you can expect a higher return. At least historically, equities, owning companies have given a better return than lending, than the bond side, where you're just lending and earning an interest. So if you have a long time horizon and you're comfortable with the ups and downs, then we'd recommend a more aggressive portfolio, if you don't need the money for 10, 20, 30 years. If you are not comfortable with the ups and downs of the market and seeing your portfolio lose money, which is just the cost of owning equities, then we move you to a more conservative portfolio with less in the market. Also, if you have a shorter time horizon, if you're saving for something, a house or college, that you're going to use in the next few years, then we'd want to be more conservative. If you're approaching retirement, that's a common one where we're moving you along the spectrum into more conservative portfolios so that you're ready to draw and the big movements in the market won't affect your plan. As far as broad diversification, we're trying to match the global market. So we have different regional exposure. US is the majority of the portfolio, but developed foreign, your Europe, developed Asia, emerging markets being developed or emerging Asia, Latin America. Um, that makes up a big, or that makes up the regions of the stocks. Growth stocks are a larger part of a portfolio than value. Value companies, if you liquidate them, they have assets there that could be your manufacturing, financial, real estate. Growth companies, your tech and your service industries, if you liquidate them, there's not as much. Value tend to be dividend producing, more predictable earnings, not as leveraged. Growth, sometimes there's a bit of leveraging going on or borrowing going on. So we're just matching the global economy. In sizes of companies, we generally have more mid-size than small. That also matches the global distribution. And then we're rebalancing. So not all those sectors are moving the same. And then we also have asset classes that are uncorrelated or mostly not moving the same. So if equities take a hit, if your stocks take a dip, that portion of your portfolio would go down. If you're targeting 50-50 stocks and non-stocks, then we'd see that equity part go down. In the non-correlated assets, that would be your gold. We use gold and bonds, those two asset classes. They generally stay steady or even move up when the markets are panicked. A lot of times you'll see those move up. And then that would trigger doing some trades, and we'd be buying while the market's down and get you back in balance. How we do rebalancing is we rebalance at meetings. So as we discuss your cash flow needs, changes in, there could be health issues, there could be different plans you want to move, or job issues. So we look at that time horizon, we look at your balance. If you've been drawing money out, we're looking at rebalancing to refill the reserve that you need for distributions. If you need required distributions because of age out of IRAs, we're looking at that at meetings. And then event-driven alerts. If markets make big moves, we'll look at rebalancing as well, just like we discussed before. We'd love to buy when things are down and sell when they're up, so that can trigger some rebalancing. And then we also want to look at tax-driven rebalancing. So in your IRAs, Roth IRAs, you can do buys and sells without triggering any tax issues. But for your taxable brokerage accounts, we want to be real conscious of what we're doing as far as generating capital gains, the types of investments in those taxable accounts. We may want to generate capital losses if we can, some loss harvesting, if there are any assets that have losses, and get that loss in the year or by the end of the year so that you can get a tax benefit, or make some sales to rebalance but not push you into a new tax bracket. So taxes are always a consideration in the investments. And then the correlated, I guess this is just a warning, the correlated or the non-correlated investments aren't always non-correlated. Sometimes when stocks go down, your gold would go down or bonds would go down as well. The idea is mostly, they're not 100% non-correlated, but mostly we'd like to, or we're hoping that they're not going to move the same. And we'll see that even within the equity portfolio, that sometimes foreign will outperform US, or small will outperform large companies, or you'll see value outperform growth and then growth outperforming value. And all those we're taking advantage of by selling when they're up and buying when they're down, because they tend to cycle. We see them go up and down. For clients interested in socially responsible investment, so we do have a standard index buy set of low-cost indexes that give you exposure in the form of exchange-traded funds. We also have a buy set for clients interested in socially responsible investing, and those are also ETFs. Some of the funds do some screening. A lot of them that we're looking at are engaging in shareholder advocacy. They hold companies, they own companies, and they can engage. They can engage on executive compensation, political contributions, supply chain conditions, disclosing environmental impacts, greenhouse gas emissions. There's a lot of diversity on boards of directors. There's a lot of issues they can engage with companies and try to make a positive change with. They're also looking at environmental, social governance factors in their. Sometimes the funds will do screening. Some of them are indexes that are just holding a portfolio or holding an index, and they're engaging with all types of companies. And some of them are actively screening based on environmental, social governance criterias. And then the same thing, we have different exchange traded funds for the different asset classes or for the different areas, and we're rebalancing with those as well. They can bring up shareholder resolutions, and they can also vote on shareholder resolutions, vote proxies. Okay. So altogether, we have these risk-based models that will really decide how much growth versus, if you're looking at portfolio performance, that's the biggest indicator, is what percent you have in fixed investments and what percent you have in equities and stock type investments. So those models will drive performance, will drive volatility. We have lots of options, and different options are appropriate for different people in different situations. Global distribution sets, so just diversified portfolios. We're not betting on who's going to do great this next quarter. We're buying the whole haystack. We're just getting broad exposure. And then as things are not perfectly correlated, we are rebalancing. You're buying when things are down, selling when they're high. We're not trying to predict downturns or booms. We're just trying to take advantage of the non-correlated movements. All right. That's all I have. Thank you. Again, I'm with AIO Financial. You can find out more information about us at aiofinancial.com. We're fee-only financial advisors. We don't get commissions. We don't sell products. We just work for our clients. We work on all areas, investments, or all personal financial issues, investments, retirement, or spending planning, taxes, insurance, and estate planning. Those are the 5 areas we cover with clients. All right. Let me know if you have any questions. Thanks a lot for watching. Bye.